Welcome to another video on the UK economy. If it's okay with you, I'd like to spend a few minutes thinking about why capital investment is low in the UK economy. It's a big issue, but also what are some of the economic consequences of a low rate of investment. Indeed, the UK has one of the lowest capital investment to GDP ratios amongst the high income countries, including Germany, United States, South Korea and others. Capital investment used in the economy as a share of GDP was just 17% of GDP in 2022. Now that's still £400 billion in total, because of course we have a 2.2 trillion economy. But things like investments in new assets, improvement to capital stock and new machinery and technology, only less than 1/5 of GDP went on investment in 2022. That's a low figure, as we'll see later on. And indeed, back in the spring of 2022, the then Chancellor Rishi Sunak was quoted as saying, "The lower level of capital investment we see in the UK by UK businesses is a pervasive economy-wide issue. It's been persistent for decades and we must fix it to improve productivity, growth and living standards." Hey, that's a really interesting and I think significant and important quote to bear in mind. Now note here, this chart shows the level of an index of the level of investment in the UK adjusted for inflation. So this is an index of real investment. The key line there is the blue line, business investment. Add in some public sector investments and you get the green line. But follow that chart and notice the cyclical nature of investment. So it tends to fall, tends to drop sharply when there's a recession, such as in 2009 and again in 2020 in the wake of and during the pandemic. Indeed, many construction projects, investment projects were put on abeyance, weren't they, during the first lockdown in particular. But there has been, can you see that in the chart, a noticeable flattening of investment growth in the UK since around 2016, 2017. This is important. So why is the UK not investing as much as other countries as a share of GDP? You might want to press the pause button, have a think yourself, and maybe jot down some ideas, and then I'll take you through some of my own thoughts. So what are some of the reasons behind the low rate of capital investment in the UK economy? Well, one is uncertainty, economic and business uncertainty. So the UK economy, of course, as you know, has been hit by several economic external shocks in recent times. The global financial crisis, the pandemic, the impact of the Brexit referendum in 2016. So these shocks to the economy undoubtedly must hit business confidence, so-called Keynesian animal spirits. And I think it does provide a partial explanation why investment has remained weak. You need a stable political and economic environment to be able to go ahead with expensive, often long-term investment decisions. So maybe we'll attribute low investments to weaknesses in our financial system and also the behaviour of managers and businesses. So certainly post-2009, in the wake of the global financial crisis, commercial banks in the UK were accused of being more interested in financing property speculation, lending money to house buyers than real capital investment. A lot of small businesses, for example, have complained that they can't get access to affordable loans when they want to retool their factories or invest in new machinery. So perhaps the financial sector has been a barrier to businesses being able to afford to raise money to fund investment. And at the level of the business, perhaps managers in companies have considered, possibly favoured short-term profits over long-term investment decisions. So there could be some weaknesses, some market failures in financial markets, some short-termism. And these are kind of behavioural aspects, I suppose, linked to investment. Might be worth thinking about. And also there's the wider issue about the infrastructure of the UK. We know there's big skills gaps. Says skills gas there, but skills gaps, infrastructure gaps, the soaring cost of energy, in particular the cost of energy for heavy industry, lots of political uncertainty, and the end of free access to the European Union single market. Those might be seen as barriers to a sustained increase in foreign direct investment. You see, FDI can be a way of adding to the investment in capital from outside the economy. I was reading a report recently that the proportion of manufacturers who think Britain's a competitive location for investment has halved to about 31% from 63% a few years ago. Britain's become perhaps less attractive to overseas investors. Maybe some of that capital spending might be shifting to countries within the European Union or to lower cost countries in Far East Asia, for example. Now, low investment is where we are. Britain does not invest really enough as a share of GDP. Why does it matter? What are some of the consequences, some of the economic effects of low investment? This is a super important question, and it might well be the focus of an exam question as well. Again, press the pause button, maybe think about why you think low investment might have wider economic consequences. So what can you come up with? What are some of the effects of a low rate of capital investment? Don't forget, investment in the UK, just 17% of GDP in 2022. Well, I think one is investment can hold back growth. So, think about the business. Think about a business near you, for example, or a car factory. Existing capital stocks, the stock of machinery and technology that you have, well, that depreciates every year, partly with age, partly with use. We all depreciate every year. So roads get damaged, machinery breaks down more frequently, houses need repairing, tools and things break down and need repairing or replacing. So we need to invest each year just for replacement purposes to maintain the capital stock. If investment's low, there's a risk that long run aggregate supply might start to diminish because we don't invest enough in replacement investment. Secondly, this is a really important point. Low investment can be linked to the fact that productivity growth is relatively low and behind that of other countries. The UK's productivity gap, the gap in output per worker, the gap in output per person hour between, for example, the UK and Germany and the United States, is partly explained by low investment. I've called it a low level of capital deepening. See, what that means is that people at work have access to less capital per worker employed. And it tends to be older. The vintage of the capital stock tends to be a bit older than in other countries. So older capital holds back productivity, and ultimately weak productivity is a constraint on real wage growth. And critically, this is really important, low investment can have an impact on our export industries and our ability of domestic firms, UK-based suppliers, to compete with imports. So exporters need investment to grow their supply capacity, to allow them to meet rising demand for exports. Low investment can be seen as a structural, if you like, a long-term cause of the UK's persistently large trade deficit in goods. And of course, X minus M, if that's negative, that acts as a drag on aggregate demand. So there we go, three, I think, quite important consequences of low investment. To sum up, slow growth holds back productivity and can be a cause of a trade deficit. Hope that makes sense. I just wanted to show this chart. I've been to the World Bank database. I wanted just to pick out 4 countries and show you the share of gross investment as a share of GDP of each country's national income. Look at China, persistently above 40% of GDP. It's a great stat to compare and contrast the UK with China, 41, 42%. Korea, South Korea, a high-income country now whose per capita incomes are zooming in on Japan. They invest around 32% of their GDP. Germany, commensurate country with us, of course, till recently a fellow member of the European Union. Germany invests around 23-24% of GDP, and there's the UK lagging behind at 16, 17, 18% of GDP. Now, this is a really useful contrast to have in your revision notes. It doesn't necessarily mean that the UK will perform more or worse, because obviously, of course, the quality of investment can matter as much as the quantity. So the efficiency of capital is something you might want to put into your evaluation. And it depends in which industries and which sectors the investment is going. But I think it does show that the UK is lagging behind on investment. So capital investment, spending on new capital, new tools, machinery, factories, and so on, new technology. It has an impact on both the demand and the supply side. Can you visualize an AD-AS diagram to show that? Hope you can. The UK has the lowest investment to GDP ratio amongst G7 nations, and this holds back the productive capacity of the nation and ultimately affects labour productivity, exports, and our living standards. But in terms of causal explanations, I think the economic and political uncertainty are 2 key factors behind investment. And so too is slow growth. because if the economy grows less quickly, demand isn't rising as fast, and therefore there's less need for investment. If we can grow the economy, then rising demand could generate more capital spending through the accelerator effect. Now, I think that investment is a super important macro topic, especially if you're taking A-level macro and IB macro exams. So hopefully you found this video useful. And if you did, perhaps you'll consider giving me a like and even pressing the subscribe button and notification for future videos. This is part of a series of videos on the UK, which I hope is giving you some good theory and some good application. Good luck with your papers and things. Stay happy, stay safe, stay curious, and crucially, see you sometime soon.